Good morning. We want to welcome you this morning to our webinar covering GASB 87. I know for many of you, we've had the pleasure of having this statement delayed for some time. I think it was one of the positives to come out of the pandemic is GASB giving some reprieve on some of these new statements. But unfortunately, it is here and it is here to stay. And so this morning, the goal will kind of be a high level, dig back in, kind of get our hands back around the statement, some of the changes coming, as well as kind of walking through a couple of real world examples. So I'm Jamie Wilkie, one of the partners here at Lauterbach and Eamon. I will be joined this morning by Tim Gavin, one of our principals as well. The goal this morning, I'll kind of start by covering some of the key highlights of the statement, talk about some of the new terminology, how the calculations for leases will work. And then I'm going to hand things over to Tim and let him kind of go into some of those examples, see the calculator that our firm has developed and kind of walk through the nuts and bolts of those journal entries as well. Just a bit of housekeeping this morning. You all should have a Q&A function towards the bottom of your screen. We will be monitoring that throughout the presentation. We will do our best to address questions, hopefully as they are coming in, but please note anything that we are not able to answer this morning, we can certainly send follow-up communication. As with any of our trainings, after today's training, you can visit the news section of our website. There you will find the slides for the presentation as well as the recording of today's training. So feel free to share with staff and invite anybody to that news page as well. So to kick things off this morning, as I said, GASB really started this lease process many years ago. The statement itself was issued pre-pandemic, and we were able to have that delay in implementation as part of GASB's response to the pandemic. But it is here to stay, and so GASB's original approach to this statement really was the philosophy that any lease is really, when you break it down, a form of financing and really should be reported as such. So the new statement is going to basically eliminate the two current categories of leases that we all kind of throw around out there. And that would be capital and operating leases. So one of the very important walkaways from this morning is that terminology out the window. We really will not categorize leases going forward as either operating or capital. We will instead be replacing that terminology with three new categories of leases. And we'll get into kind of more details on all of these, but those will be short-term leases, contracts that transfer ownership, and then all other leases, which really is kind of the catch-all statement. And so that category really is the focus of GASB 87. As we continue through the slides, you'll see that short-term leases and those contracts or leases that transfer ownership of the asset really are exclusions under GASB 87. The new statement will in fact change how we recognize leases, how we measure them, and of course with GASB we'll have new required disclosures as well depending on the category of lease. Some important things to note, I think one of the positives of this statement is that GASB was approaching the kind of remeasurement of leases both from the lessee and lessor perspective. So I think the idea that the recording of this will kind of match on both sides of the transaction, I do think is a positive as we go through implementation. And remember, this also applies to both the revenue and the expense side of lease transactions. So whether you're the lessee in a transaction or the lessor, we will have to analyze both sides of potential contracts to see if they meet the criteria of GASB 87. So effective dates, really this next kind of upcoming cycle. So with the delayed implementation, the new effective dates are for periods beginning after June 15th of 2021. So our first kind of key target group that will be implementing the new standard is really our June 30th, 2022 fiscal year ends, and then thereafter. So we'll be gearing up with our summer year-end clients and then working through December and then the following April year-end clients. So we want to talk a little bit about, where we are today, what kind of implementation steps you all can be undertaking now. So really, trying to break this down into very high level instructions here. This statement and then the implementation guide that was released in 2019, it's one of the more technical statements. Our goal this morning is to not go into some of the intricacies and talk about detailed contract language, but to really make sure you all can walk away with kind of general understanding of what's happening as we go through the transition with GASB 87. I think any of you that have specific contracts that you're not sure about, we're going to provide a tool at the end. Tim will walk through where you can kind of start gathering contract information, and then certainly reach out to us, reach out to your primary contacts here at Lauterbach and Amon, and we can start having those discussions of maybe some of the nuances that you have in contracts. But for today's purposes, we need to start somewhere, right? So step one is really identifying all of those potential leases. And remember, we need to look at this both from the lessee perspective as well as the lessor perspective. We need to start gathering data, right? So what kind of lease agreements do we have? Do we have copies of them? What are the payment terms? Is there an interest rate assigned? And Tim's going to walk through, we kind of have a nice tab within our calculator that you can start gathering that information. I think much of this really relates to communication with other departments. Leases tend to be a little bit decentralized, meaning sometimes the finance department isn't probably even aware that some of them exist. So I think it's important to have conversations with other departments, public safety or public works, parks and recreation departments, et cetera. Really making sure that you've got a good handle on potential contracts that are out there. And then really kind of preparing for implementation, making sure you've got copies of those leases. We'll walk through the calculator. We'll be providing the calculator as well on our news website, where you can kind of click through and start taking a look at generating the journal entries, et cetera. But as with any GASB implementation, LNA is here to assist. We're here to help walk you through those entries, but we want to make sure you've got the tools to kind of do it internally as well. So as I mentioned, we will have 3 new categories of leases. And so first and foremost, no more operating and capital leases. As I stated, we'll have 3 new categories. The short-term leases, those contracts that actually transfer ownership, and then that catch-all category of all other leases. Again, important walk away from today. Category 3 is really the kind of primary category that GASB 87 applies to. So our new statement applies to really any contracts that convey control of the right to use an underlying asset from another entity. So just keep that in mind. This isn't just necessarily taking a look at your traditional leases, but really digging into any contracts where there's a right to use an asset, there's an exchange or exchange-like transaction to have the ability to use that asset. So just because the word lease isn't used in a contract doesn't necessarily mean that we won't have to analyze it as part of GASB 87. So just kind of keep that in mind as we go through the rest of these slides. So category 1, as I mentioned, is our short-term lease category. This category, the definition, and we've tried to really simplify this, as I said, to kind of really take a look at it at a very high level, is a lease with basically a term of less than 12 months, including any options to extend. So these would typically be things like maybe your copier leases, things that are less than 12 months, including those options to extend. So what is the accounting going to be for those? Really very similar to operating leases now. If you're the lessee, you're expensing those lease payments. And if you're the lessor, you're recognizing that lease revenue. So really no significant change. Obviously, there's a good correlation here between the current operating lease definition and this short-term lease category. And no disclosure that's going to be changed or required under GASB 87 for these types of leases. So again, this is an exclusion to GASB 87. Our second exclusion category of leases is those contracts that transfer ownership. So definition here, again, at a very basic level, the underlying asset that you are leasing transfers ownership at the end of the term of the lease, meaning you own it at the end. What GASB has said is this is really no different than financing any other purchase of an asset, similar to a loan. Even when you go out and issue bonds, for example, for an asset acquisition, there's really no fundamental difference between a lease that transfers ownership and going out and getting a bank loan where you purchase an asset. And so from the lessee's perspective, this really is just a financed purchase of an asset like a loan. And from the lessor's perspective, they're really selling an asset. So disclosure-wise, the lessee will have the typical capital asset and loan disclosures or long-term debt disclosures. The lessor will be reporting basically a sale of an asset on their books. So this would be, again, one of those exclusions from GASB 87 and really treated like any other long-term debt that's issued for the acquisition of a long-term asset. So category 3, as I said, becomes our target for GASB 87 discussion. And in a very simple definition, if it doesn't meet category 1 and doesn't meet category 2, then we probably need to address it under category 3. So we've determined it's not short-term. We've determined that there's no transfer of ownership at the end of the term of the lease. Obviously, as I said, there is a 47-page implementation guide. The standard is over double that in length. So this is a very simplified definition, but I think for today's purposes of getting our feet back into GASB 87, really this becomes the catch-all category that it hasn't met the criteria of short-term and it hasn't met the criteria of that transfer of ownership. So from an accounting perspective, this is really the big change for GASB 87. If you are the lessee, and we'll go through this in a little bit more detail, I promise, you are basically recording a leased asset on your books, or the right to use that asset, if that makes sense, and a lease liability. If you are the lessor, you are going to have a lease receivable, and that will be offset by a deferred inflow of lease revenues or deferred lease revenue. So you will earn that revenue as the term of the lease transpires. We do have disclosure changes under GASB 87 for both the lessee and the lessor, so just keep that in mind. So a little bit more on this category. So from the lessee's perspective, at the start of that lease, the lessee will recognize a lease liability and an intangible right to use that leased asset. So when you think about intangible assets and you start thinking about disclosure as we kind of look forward, this means that these assets will be recorded similarly to how you record your capital assets now. So we will have kind of a new capital asset type category that will be called our intangible leased assets. That lease liability at commencement is measured as the present value of those future lease payments. Any payments then on the liability in the future, think of principal, will reduce that liability. And then you'll also recognize lease expense at the time of each of those repayments. Initially, that leased asset or the intangible right to use that asset is going to equal the lease liability. So in the first year of that lease, those two will be equal, and we'll kind of walk through the debits and credits here a little further. And we'll basically amortize that lease asset over the shorter of either the lease term itself or the useful life of the underlying asset. So that again is from the lessee's perspective with regards to category 3. It's met the criteria of GASB 87, and we now need to measure it. If we kind of turn the tables and take a look at the lessor's side, at that lease commencement, they will recognize a lease receivable and deferred inflows of resources. That lease receivable really equals the same value as the lessee's lease liability. As the lessor receives payments in the future, it's going to obviously reduce the receivable, and they will recognize interest on that lease. On the kind of liability side or deferred lease revenue side of the transaction, again, it will initially exactly match that lease receivable amount. And as payments are made, revenue will be recognized, and then that lease deferred revenue will be amortized over the lease term in a straight line methodology. But remember, in this case, the lessor still owns the underlying asset and will continue to report that underlying asset as a capital asset on their books with applicable depreciation expense. So that's kind of one little nuance from the lessor's perspective, that they still own the capital asset and should still report the capital asset as you normally would. So kind of what do the general debits and credits look like? Again, we'll go back to the lessee's perspective. So we're pretending here that the lease is happening in a governmental fund or a modified accrual fund. So we enter into the lease. What happens in that governmental fund when the lease is initiated is we're going to debit some kind of capital outlay type expenditure for the full value of that lease, and we're going to credit lease proceeds. When you think about it, this is really no different than current reporting for a capital lease. So there are some commonalities you're going to see related to our old categories of lease that were kind of pieces brought into the new statement. But again, at the start of any lease under GASB 87, if we're in that modified accrual fund, we're still going to have a debit to capital outlay and a credit to lease proceeds. The net effect is really zero to the income statement when you look at that transaction. For any of you then where we have to convert to the government-wide statements, this is really where GASB 87 changes things. So you'll see the fund level is really no different than we've reported in the past, but our change comes when we go to full accrual financial statements. So again, if you're the lessee, we've got to remove those lease proceeds off of the income statement and recognize our lease liability. That capital outlay expenditure now needs to come off of the income statement and be recognized as a leased intangible asset. So I know this is very basic, but in theory, we're moving from governmental fund level statements to those entity-wide statements, and GASB 87 is really applicable to those government-wide statements where we're creating this new lease intangible asset and lease liability. So that was the initiation of the lease. We then have future payments that are being made on the lease. And so when those payments happen again in your governmental fund, really no different than current practice of recognizing lease payments. You'll have probably a principal component, an interest component, and then a reduction in cash. So we're hitting expense and crediting cash. But now we've got to take care of those full accrual adjustments because now there's been a payment made and we had created a lease liability and a leased asset on the entity-wide statements. And so that principal component really becomes a reduction in that lease liability. And then the interest is going to remain interest expense, similar to how we record things traditionally today. But then we have to amortize that leased asset. And remember, that's over the shorter of either the term of the lease or the useful life of the underlying asset. And in theory, the lessor is reporting kind of the opposite of this transaction. All right, so from the lessor's perspective, again, almost the opposite transaction here, but a little bit of a nuanced difference. At the start of the lease, the recording in the governmental funds is actually going to almost kind of skip forward to the entity-wide statements, and we will be recording the lease receivable and the deferred inflows of resources or deferred lease revenue in the governmental funds. So this is kind of the one little nuance as we compare kind of the two sides of the transaction between the lessee and the lessor. The lessor then will receive future payments. So they have an inflow to cash. They're going to reduce the lease receivable for that principal component and get to recognize interest revenue for the interest component. We also have to basically reduce the deferred revenue and now recognize the lease revenue. And so that again is done systematically, straight line over the term of the lease from the lessor's perspective. But remember, in this case with the lessor, they still own the underlying asset. So I put the little kind of box at the bottom of the slide to remind you, you'll still be depreciating that asset as you normally would each year. Disclosures, as I indicated, we will have some disclosure changes to the footnotes for both the lessee and the lessors. On the lessee perspective, obviously a description of the lease, general lease terms, the total leased assets that are recognized, and those future payment schedules for principal and interest. On the lessor side, very similar general description of the lease arrangement, and then basically an outline of that lease revenue being recognized during the year. Again, we have simplified this for this morning's discussion purposes. Remember that lease asset from the lessee's perspective, as well as the lease liability. The details of that will also have to come into your disclosures. Typically, those will come in kind of on the two sides of the equation, if that makes sense. So wherever we're disclosing your capital asset disclosures, we will add to that then the intangible lease asset disclosure. And wherever you're recording kind of your long-term debt disclosures, we will be recording kind of the lease liability within the liability section of your notes as well. So the leases will kind of populate in a couple of different areas within the notes as we move forward with implementation. Other considerations, begin planning now, guys. I know, I think this is a statement, I'll be honest, that I think everybody's kind of concerned about, we're going to have to gather this information and do these calculations. While I do think this statement is significant, I think once you take a look at the two exception categories, while I think many entities will still have maybe a lease or few that are still qualifying under GASB 87, I think it was helpful that GASB excluded those short-term leases as well as those leases that transfer ownership of the asset. And then hopefully what's left in that third category is much more manageable as it relates to the GASB implementation. I have my big smiley face on my second bullet point here. We need to be practical. We are going to be applying materiality. We're not going to be recording immaterial leases, regardless of what category they potentially fall in. And remember, again, this doesn't apply to those short-term leases or the contracts that transfer ownership. So it's really a much smaller group of quote leases that we will have to be analyzing as part of this process. So hopefully that makes it a little less scary as we kind of head into implementation. I'm going to pause here because this is really the end of kind of the discussion slides. Tim, I'm seeing maybe a Q&A. Yep. So we did have a question. I just want to pause briefly. Can this presentation be shared later? Yes. So for any of you that missed the very front part of this presentation, we are recording today the slides as well as the calculator that Tim will be reviewing here in just a few moments. Will be placed out on the news section of Lauterbach and Neiman's website, along with any of the other webinars we've done over the last year plus. So feel free to access any of that information at any time. Feel free to share it. Really, our goal is to put that out there as education for you all to be able to have access to. So I will put up the last slide just if you have follow-up questions. After the presentation today, Tim and I are always happy to field any of those questions. So email or calling our office line, you'll be able to be routed to us. But I will be switching gears now and allowing Tim to share his screen, and he will be walking us through some real world kind of examples, and hopefully that will help kind of shed some light on some of these inputs, as well as our debits and credits related to GASB 87. So Tim, I am turning over to you.
Okay, thank you very much. I have to do a little juggling here to make sure I can share my video. There we go, and I'm going to share my screen. Okay, hopefully everyone can see my screen now and get into, I like to call the practical portion of the event here today. All of the technical stuff is great, and it's good conceptual information, but we all know once you get into the real world, so to speak, kind of all bets are off. And I always find it helpful to have some practical examples to see how this works in action. So that's what we're going to do. And as Jamie mentioned, we did include a tab, and that's what you're looking at right now, that will help you accumulate all the relevant information that you need for all of your leases. And I recommend anything that is possibly considered a lease, even if it doesn't end up being reported under GASB 87, use this to list them all out. We can help review this list and make those determinations, but it's really its initial useful aspect. So, what we've got here is a sample cell tower lease, with a gross value. We have what the term is, start date and end date, automatically calculated, what the number of months is. So if this is a much longer term, we get that. Oops, not 1930. That is silly. We get that automatically updated. You get to enter in the amount of regular payments, the interest rate, any residual value at the end of the lease, when the first payment is due, the frequency of the payments, and whether or not you have a copy of the agreement. It sets the stage for success with all the future steps, especially this having a copy of the lease agreement when deciding whether or not something needs to be reported under GASB 87. And some of the nuances that might show up, the lease agreement is going to be the best source of information. But this gives you, at a glance, all of the information that's going to be relevant to making some of those calculations. So what I'm going to do is run through two actual leases and utilize our calculator. I'm going to do everything from the lessee standpoint because the lessor is effectively the same methodology. The calculations are basically the same. I think out in the world, you guys are probably more lessees than lessors, but we'll get into that. So the initial section here is the lease liability calculator. I'm also going to pull up the first sample lease. So this is an example lease for, I believe, just some equipment. And the important part that I'm sharing here is the schedule of payments. So this is going to have the relevant dollar amounts that we need to plug into the calculator. So what we initially see here is some date information, some monthly payment information. And then if I scroll down to the bottom, I've got the rest of the information I need. So I've got some totals. the sum total of the payments I'm going to make, and the totals broken down between the interest component and the principal component and the interest rate. So I'm going to start plugging these numbers into the calculator, starting with the sum of the principal amounts here. So this 83,915.10. So in the calculator, this first item here is amount of regular payments. So the that's going to, yeah, let's see, I said I was going to start with the 83,915.10. That's actually the number I'm going to end up with, because that's effectively the net present value of the lease payments. So I'm actually going to enter in the monthly payment amount, so $1526.83 right here in the calculator. So $1526.83. That's the amount of the recurring payments that I'm making. The number of months for the lease term, referring back to the agreement, we have 60 payments. So a 5-year lease term equals 60 months of payments. Now, the annual interest rate is also coming from that agreement. We have an annual interest rate of 3.63%. I'm going to plug that in here. So it automatically will figure in the monthly interest rate. Should also mention that before this goes out into the wild, right now it's functional, and we're gonna polish it up a little bit and add a few things for flexibility. We've done a small handful of implementations already, and just based on what we've seen in the wild so far, the tool is going to allow some flexibility to accommodate more situations that we've seen. So I've plugged in the interest rate. It's automatically calculating the monthly rate. Well, we're saying that payments are made at the beginning of the period, and the first payment date, I believe, and now this is obviously an old lease, but we've got a first payment date of August 24th, 2016. So we'll plug that in here. So you may have noticed by the time I entered the amount of regular payments, the lease term, the annual interest rate, this present value matches that principal value. So the total of the principal amount are adding up to this present value. So what I have now down below is an amortization of the payments, the related principal amounts, and the reduction of the balance by those principal payments. As is usual, there's a little bit of a rounding difference toward the end, so may require a couple of overrides near the end, but that is the all the inputs needed to calculate that lease liability here. Now, moving over to the lease amortization of the asset, the tool automatically pulls over that lease asset value as being equal to the liability at the beginning of the lease. And the useful life, in theory, you can have a different useful life for the asset than you do for the liability. I think in practice, it's going to be exceedingly rare that you would. So in this case, we are going to enter 60 months as the useful life of the underlying asset. So that will automatically calculate that monthly amortization expense, as well as stretch that out into an annual expense. And again, some automation here. It's pulling the date based on the prior table. So our monthly amortization amount is reducing the balance accordingly. And again, adjusting for some rounding, we have a little bit of residual at the end. So a little bit of an adjustment there, but this is the schedule that sets forth the amortization component that you'll book on an ongoing basis. So again, pretty simple. All you really need to know here is the useful life of the asset. And that brings us over to the sample entries, which is great because these all pull in automatically. So, you know, I find sample entries to be extremely helpful. And I know Jamie went through the items from the slides in a, you know, kind of a high level. Using some real numbers here kind of reinforces what we're doing. So the first entry is, you know, the inception of the lease, and that total liability amount, the total principal amount that we're paying is what we're going to be reporting here at the fund level, you know, in the governmental fund as a capital outlay expenditure with a corresponding other financing source representing the lease proceeds. So again, fund balance neutral, just kind of grossing up both sides of the income statement here. But that's where the dollar amount is going to be coming from. It's that principal value at the beginning of the lease. And then we have this principal retirement and interest expenditure that we will record on an ongoing basis. Now this does assume an April year end. So these numbers may vary depending on where your end of the year is. We're may try to build in some additional automation here, but the concepts are the same. Over the course of every month, you're recognizing an expenditure that is reducing the liability as well as the additional interest component. Obviously, you're actually making those payments. So the credit is to cash to show that going out. We've gone another step further to recognize what is happening at the government-wide level. So as we discussed earlier, that other financing source needs to go away since we don't have that at the government-wide level. And that basically is converted into that lease liability that will be reduced by future payments. So inception of the lease, governmental fund, we have that expenditure and the other financing source. Here we're scooting that other financing source over onto the balance sheet to show it as a liability. And then to get rid of that capital outlay expenditure, since again, we don't, we want to move these over to the balance sheet at the government-wide level. We've got that intangible asset that is now showing up on the balance sheet and eliminating that capital outlay expenditure that we showed at the fund level. And then on an ongoing basis, again, assuming an April year end, we need to reduce that lease payable liability. So our principal expenditure at the fund level becomes a liability reduction. So we get rid of the expenditure and show that liability being relieved. We leave the interest as it is because that is a period expense. And finally, we need to continue to draw down that intangible asset that we're showing for the asset that we're leasing. Now, you'll notice because of the difference in the nature of amortizing an asset versus paying down debt with an interest component, this amortization is going to be different than the amount that you are reducing the liability. So the only time that those two numbers will definitely equal is at the very beginning of the lease and the very end of the lease, when they're both the full amount and they're both zero at the end. In the middle, and this is why we calculate these two things separately, is because that annual amortization is going to be a different amount. So that's what we're showing here. We are recognizing that expense for the amortization, and we're showing the effective reduction of the asset through the accumulated amortization. in effect, it's the same as straight line depreciating a capital asset. So these are the numbers that have resulted from that first sample lease. I want to do another one because it presents a slightly different look. And we are going to pull up our second example lease here. So this lease is for, looks like it's for some software, and we have a total amount financed of 4.6 million at an interest rate of 4.6%. And here we actually have annual payments over 5 years. So this presents a unique situation because, you know, this calculator doesn't, it doesn't have an annual payment option, but also these annual payment dates are, you know, I highly doubt anyone has a November 7th year end. So in other words, it doesn't align with a fiscal year or even a calendar year end. So it's useful to have those kind of monthly numbers that hit at certain milestones. So what we're going to do is take these numbers and enter them into the calculator that effectuate a monthly basis. So this rent payment amount, as we recall from our first example lease, we took that kind of gross payment amount and entered it in first. So this $1,027,775.75, we're going to enter that in, but we're going to divide it by 12 to effectively tell the calculator that we're making that on a monthly basis. So $1,027,000, we're going to plug in here, and actually I'm just going to clear this out so we don't get too confused, but we have $1,027,000, and I remembered that, so I'm proud of myself. And we're dividing that by 12. So effectively, we're making $85,000 payments on a monthly basis, but actually doing the cash on an annual basis. So because we are putting in a monthly amount here, instead of 5 years for the lease term, I am going to put 60 months again. So with the interest rate of 4.6%, you can see we are awfully close. And, you know, if you ask us as your auditor, awfully close is good enough. You can certainly make adjustments if you really would like to get this down to an exact 4.6 million for our purposes today. 4,600,486 is plenty close for our purposes. And first payment date. This is another unique thing because what I really want is to end up with the sum of the first 12 payments to, you know, equal a regular payment on the first payment date. So looking back at the example lease, we have a first payment date of November 7th, 19. I'm going to back that up so that this will accumulate to this amount. And you'll see how this works in a moment. So I'm going to actually send this back to 2018 because that's when we started the lease. So it's November 26th, 18. I'm going to start this here in December. I think this works right. So when I start this in December of 18, which is almost a year earlier than the first payment, and I add up the first 12 amounts, what I have is that $1,027,000 showing up right on November of 2019 when that first payment is made. So I've effectively gotten to these milestone payment dates with the correct dollars, and adding up the interest, you'll see the same thing, about $175,000, which is around what the first interest payment is made. So again, it's not exact to the lease itself, but it's gotten us close enough for reporting purposes. So that gets us to where we want to be in terms of calculating the liability. The rest is kind of right where we were at before as well. Coming over here to the asset amortization, I'm going to keep that 60 months there, and again, in most cases, I think you'd be hard pressed to find a situation where that asset life is going to be different than the term of the lease. So we're going to leave 60 in there as reflective of the lease term. And again, the monthly amortization amount, calculating out to the annual amount, is getting us that those dollars with a little bit of rounding at the end, and the amounts that we need to report for the asset amortization. So just to reinforce the concept, I'm going to go back through the sample entries because I personally think it's very helpful. So the lease liability and the lease asset are coming in at the same amount as we expected. And again, capital outlay expenditure and the corresponding other financing source for lease proceeds in a governmental fund at the beginning of the lease. And then on an ongoing basis, we are making principal payments, we are making interest payments, and showing that cash going out the door. And then at the government-wide level, of course, we are at the exception of the lease, making sure we are adding the liability and the intangible asset while eliminating those income statement amounts. I'm actually going to take this opportunity to kind of illustrate what you would do in a proprietary fund when you are not restricted by the bounds of modified accrual. In a proprietary fund, if you're leasing an asset in your water fund or something similar, you are going to go straight to this section, but you won't need to eliminate things from the income statement. If you are at the commencement of the lease, you'll put the liability straight on the books as well as the intangible asset. So in effect, your entry will look effectively like this, where you are crediting that liability and debiting that asset all in one entry. So effectively ending up at the right point, but knowing the difference between having to start at the income statement and eliminate versus going straight to the balance sheet. So that's how that's going to work. And then, again, reducing the liability by the amount of principal we paid and eliminating the expenditure, as well as expensing that amortization, similar to depreciation on a straight line basis. Again, illustrating the difference between how that liability is reduced versus how that asset is written down on an ongoing basis. So those are the two example leases we had prepared. Hopefully this tool proves to be helpful. Like I said, we're going to work with it a little bit before we send it out into the wild to add a little bit of flexibility and a little bit of polish. Hopefully it's been helpful to see these things in action. I'm going to pull, let's see, I think I can pull this last slide back up again. So with our contact info, but oops, I did not do it correctly. Well, at this point, like I said, we're happy to answer any questions. So please use the Q&A function and let us know if Any questions based on what we've presented today? But there, you should see our contact info. So again, jot down our email addresses. As Jamie mentioned earlier, we're always happy to answer any questions after the fact that may come up.
All right. I'm not seeing any, Tim. I don't know if everybody is still digesting this morning, it looks like. Actually, I see one coming in. How will this work for those of us that have enterprise vehicle leases? I think for some of these unique lease arrangements that we're seeing out there, I'll let you kind of pipe in too, Tim, but I think a lot of it's going to come down to really reviewing the terminology within the agreement itself. And we'll really have to take a look at, is there a transfer of ownership or not? What are the terms of the lease, et cetera? So unfortunately, there's not a one size fits all answer to some of these questions. It really will come back to reviewing that lease agreement and kind of why it's important in that tracker to make sure we've got copies of all the pertinent pieces of that lease.
Agreed. Yeah, there's going to be a lot of individual analysis.
Yes.
Yes. And the fact that despite the fact we have done a couple of implementations, no one has been eager to do this one. So as soon as we were, with a couple of rare exceptions, but right. As soon as the word came out that they were delaying this one, everyone right. took full advantage of the grace period. Yes. So we haven't seen a ton out in the wild yet.
No, I don't think there were a lot of eager early implementers by any means. So
I had one.
Yes. So again, happy to answer any questions. We know this is a big kind of cumbersome statement coming at us here quickly. So follow up with any of those questions. We're happy to answer those. Sorry, there's one more coming in. Assuming a lease term ends during the affected fiscal year, I'm assuming that we can ignore those. So yes, in essence, you know, the theory here would be that they would be treated as short term, if that makes sense. So that would be an applicable exclusion from GASB 87. Yep. How are existing leases in midterm supposed to be reported upon implementation? You're basically analyzing the lease, not from the start of the lease agreement, if that was pre-implementation of GASB 87, if that makes sense. But effectively, we will have to go back to the beginning of your year of implementation to see what leases were in effect at that point in time, and then what the term or repayment period is from that first day of the fiscal year that you're required to implement. Does that make sense, Tim?
Yes.
Really, you're almost, if you're implementing June 30th, 2022, we're actually looking at the leases that would have been in effect July 1 of 21 and doing that analysis. So hopefully that answers that question. Entities on a modified cash basis, not full accrual, you're not recording capital assets or long-term debt in the government-wide financial statements. Do you anticipate that leases would be posted and reported? My comment here on modified cash basis is those statements, I call them the wild, wild west of financial reporting. I can tell you some modified cash clients do report components of capital assets and or long-term debt. So I do not think there's a one-size-fits-all answer here as well for any of you that are reporting under the modified cash basis. So again, we would have to kind of analyze that client by client as we move forward.
Yeah, I think my opinion on that would be if you have, you know, modified is kind of, you set the modifications and then follow Correct. Them and be consistent. So if you've Correct. Established a pattern of recognizing capital assets, which would include intangibles, and right. long-term debt, which would include lease liabilities, then I think you're likely to be reporting right. these.
I would agree. Yep. And the last question I'm seeing here, and this is a great one, it is addressed in the implementation guide. It's one of the very first questions in the implementation guide. Many of you enter into agreements. So the example here is, how would you apply this to a land lease for $1 or really low amount similar to that? One of the caveats of GASB 87 is there has to be a reasonable exchange or exchange-like transaction, meaning there has to, in theory, be some kind of market value that's attached to your ability to use that asset. So those leases for $1, in theory, would not apply under this statement. So that was a great question. And again, it is addressed in the implementation guide. For any of you, head to the GASB website. Its implementation guide 2019-3 is specific to leases. And again, it's about 47 pages that specifically cover the lease statement. So again, we want to thank you all for joining us this morning. Please follow up with any questions. And I think that clears the Q&A this morning, Tim. So thank you all. We will see you all soon.
All right.